Everyone tells you to pull up the charts first. Well, I did exactly the opposite. Before I even opened the gold chart, I already knew the direction that it was going to go in. By the end of this video, you'll understand why and how I was able to get out the market before the major crash that we're still in right now. In this video, I'll be breaking down my full institutional process of why I got in the market, what I do when I'm in a trade, and how I was able to get out before the major reversal occurred. So first of all, here's the exact position that I took. We see that this position was on gold and I was able to secure 6.25%. So before even ever entering a trade, what I always do is my fundamental analysis. My fundamental analysis tells me what to trade and in which direction that asset is going to go. Is it going to go up or is it going to go down? Here, the trade that I took was on XAU/USD, which means that it is the comparison of 1 ounce of gold versus how much it costs. So pretty much the cost of 1 ounce of gold. So the way that I always do my fundamental analysis is I split them in two. So first of all, what do we have for our fundamental analysis when it came to the US dollar? Well, we had interest rates going down. Now, what are interest rates and why does it affect the market if it's going up or down? Well, to understand that, there's a whole system behind it. So each currency, in this case, since it's the USD, is attached to a central bank. I'm just going to put CB over here. And the central bank has a job. The central bank's job is the dual mandate. Now, what is that dual mandate exactly? And why are we talking about this? So the dual mandate is inflation and unemployment rates. So the central bank's job, which in the US is called the Fed's job is being able to maintain inflation that is between 2 to 3% and unemployment rates below 5%. Now, when you're going to hear the Fed's president or the Fed chairman speak or anyone in the committee of the Fed, they're always going to say that their target is 2%. And that is very, very true. However, anything between 2 to 3% is still historically low, and you'll understand a bit later why I'm mentioning this. So their target is 2%, but as I said, anything between 2 to 3% is acceptable, and unemployment below 5%. Now, why am I mentioning all of this in the first place? Well, all of this is the Fed's objective, especially the dual mandate. Now, how does the Fed even get to their objective in the first place? Well, they have their tools. And the main tool that they use is hiking and cutting interest rates. So hiking, which means like pretty much upping interest rates, and cutting, which pretty much means like lowering interest rates. So that is the main market mover. That is the main tool that the Fed uses to cut interest rates or hike interest rates so we can get to our 3% inflation objective and to our 5% unemployment objective. Now, why do they use interest rates and what is the logic behind hiking or cutting interest rates? You have to understand first, what is even inflation in the first place? Well, inflation is what happens when we have too much money circulating. And when we have too much money circulating, that can be counterproductive for the economy because we don't have salaries that are moving at the same pace. So what the central bank does to remove buying power from the population is that they raise interest rates. Because if interest is high, then people will be less tempted to buy houses, buy cars. The money that is circulating starts slowing down. Now, in this context, when I took the trade, the American central bank was lowering interest rates. But why would they even lower interest rates in the first place? Well, because here I'm going to show you guys, and this is a site that I use called Trading Economics. All of my macroeconomic data, I get them from this site. So what we see is that for the past multiple months before 2025, inflation was pretty high. We can see 3%, 3.2, 3.7, 3.7, and etc. We were in the over 3%, which is over the range that I mentioned to you guys. And at that time, what the Fed did was they hiked interest rates. They hiked interest rates, and as I said, when the interest rates are hiked, well, it gives less buying power to the population, which means that inflation starts climbing down, and that's exactly what we have. We can see that in 2024, inflation started to lower, and we were in the below 3% range. Now, when inflation starts going down, well, what the interest bank does is that it follows with it. It starts going down. So imagine that this is inflation. Inflation slowly climbs up, and then the Fed realizes that inflation is going up. So what do? They hike interest rates. And the way they do it is once it started to climb up, so let's say it started to climb up over here, well, somewhere over here, they start raising interest rates, just like this. So just calculate that this here is like a timeline on multiple months, all right? Just like this. The central bank starts hiking interest rates, which start bringing inflation automatically down. Now, the Fed doesn't want to continuously raise interest rates because in that case, well, we don't want to have no inflation whatsoever. No inflation means that the economy is not growing. Hence why the perfect percentage that we have is between 2 to 3%. So once inflation starts going down, well, the central bank starts cutting interest rates. And when they start cutting interest rates, it's to stabilize the economy because we do not want to have an economy, as I said, that is not rolling. So here, after 2025, we saw that interest rates were going down. Now, between somewhere April and July, September-ish, interest rates went back up because of the tariffs. But the central bank judged that it was only up because of the tariffs and it wasn't real inflation data. Now, why am I even talking about interest rates in the first place? And I'm about to break you down the analogy right over here. When we have interest rates going up, it makes foreign investors invest in that country's currency. Why do they invest? Because one part of it is called a self-fulfilling prophecy. Since some people know that other people will invest in it because of interest rates going up, well, the rest of the people follow. That's one of the reasons. The second reason is imagine having a bank account where you put money there and you gain 0% of interest in that bank account. Well, we all know you're practically losing money at that point because since inflation is going up, your money accumulating 0% of profits, well, it's actually losing its value because it's not catching up with inflation. Now, when there's another bank that tells you, hey, bring your capital to me and I'll give you 4% interest on that capital. So what the people do is that they sell the currency that they had, which was bringing them 0% interest rates, and they go to a higher interest rate currency. So that's exactly the logic of what happens when interest rates go up. Now, on the contrary, when interest rates go down, well, they know that the interest that they're getting from that bank account is no longer 4%, but then it goes to 3% or 2%, and so on and so on. So they start selling that currency, which means that that currency's value goes down. Now, in this case, since inflation was going down, just like I showed you over here, which automatically meant that the Fed was cutting interest rates, well, people started selling their USD. And what is the number one asset that liquidity is transferred to when the USD is sold? Well, it's to gold. So that being said, we had the American central bank that started cutting rates, which automatically means that the USD is bearish. So now that we have the fundamentals for the USD, well, what are the fundamentals for gold? obviously we have this, which is a major one, USD cutting interest rates, but we also had all major central banks that were buying gold, and they were adding tons and tons and tons of gold in their reserves. One bank that actually bought so much gold, way more than the others, and was the reason that we had the major bull run in gold, was China. At that time, China was at its 15th consecutive month buying gold and adding gold to their reserve. Now, there are numbers that are flowing around of how much China was buying each and every month, but the economists were judging that those numbers were fabricated and that China was actually buying way more than they were actually declaring in their papers. But how does central banks buying gold affect the gold prices? Well, I'm going to explain to you guys a concept that's called supply and demand. So imagine we have 100 people that want to buy 100 apples, and the price of that apple is $1. Now, this is the stable price. $1 would be the stable price of that apple. Now imagine if we had 100 people wanting to buy 50 apples. Well, what do you guys think happens? Well, obviously the prices of the apple goes up and it becomes $2, because what we have here is the same amount of demand for less supply, which automatically means that each apple cost is more expensive. Now, in another context, imagine we have 200 people that want to buy 100 apples. Well, what happens then? The price of the apple still goes up because we have more demand for the same amount of supply, which pretty much comes up to the same thing over here. So since all major central banks were buying gold, that means there was less gold out there to be bought, which made gold even rarer and elevated its price. So here we have major central banks buying gold. The other fundamental point of gold is that we had war uncertainty. And now people watching this video are going to be like, we're in war right now and gold prices are coming down. Yes, I'm aware of that. There's a huge nuance between gold and wars and uncertainties. Gold is a currency that goes up when we have mid-level uncertainty. So usually what happens is before the war actually sparks, since there's uncertainty, gold starts going up. But when we have major crashes, everything crashes. Gold crashes, indices crash, and people sell their assets to go back to cash. And in that case, what happens is that the USD starts going back up since people sold their assets to go back to cash. Now, before taking the trade, we were still in very uncertain moments. And all of these combined together meant that gold was going to go up. This is exactly what I meant by I don't even need to open the charts to know that gold prices were going to go up, because my fundamental analysis told me already. An important nuance that I want you guys to remember is that when there's a crash, everything crashes, even gold. And if you guys remember that I said that, well, USD goes up. Now I want you guys to remember that because it's going to be important for the end of the video. So now for the technical side of things, our fundamentals told us that gold was going to go up, but fundamentals only tell us what to trade and in which direction it's going to go. And technicals give us the timing of when that leg up is going to happen. So initially my trade idea was to play the breakout, and I was aiming one of my Fibonacci extension levels right over here. So what was even the setup that we had technically? Well, here we had a trend line. We had a major key level right over here, which was a psychological level, as well as a level that was tested multiple times. And one thing that I always look out before taking a breakout trade is if we have price coming back and testing one of our Fibonacci levels right over here. what we also had was a clear pattern before our breakout. Here we can see that we had a move up. We had a 1, 2, 3 right over here like this. And I was expecting price to go back up. So now that our fundamentals align with our technical analysis, all I had to do was wait to take the trade. In this morning, this was a Friday morning when I was taking a trade, we were going to have PCE data, which is some type of inflation data. Now, my idea was that if we're able to have good momentum and break out of that level before PCE data, then that is showing a certain strength. And if we have good momentum, it would give me time to put myself in break even before PCE data comes out, which would protect me from a loss. So then what happened was we started breaking out. Since we wicked at another key level that I was waiting, I was already at break even and I let the trade ride. Eventually, price started to move. We touched the key level, went back down, and then I did something that is called a add-on. Now, what is an add-on? An add-on is basically me taking a second position for the same trade. Now, why did I do an add-on? And no, add-ons aren't gambling, add-ons aren't over trading. An add-on is only used when you've either secured profits or you're already on break even on the first initial position. And when you're in that first initial position, we have the market forming a potential second entry. Now, another reason why I took the add-on was, did I have a fundamental change? No. Was the technical bad? No, it wasn't. So I added my second position. At that time, I had already secured 25% profits right over here, and I was already on break even, which meant that in total, I was pretty much risking 0.4% to have a potential 15% gain if the trade would have hit the final take profit. So if you ask me, that's extremely worth it. I'm risking 0.4% to make 15%. So I entered the trade as an add-on and then market closed because I took this trade on a Friday. And market opens and we see that we gapped up all the way over here. Now, when I saw this gap at first and saw the price action, I had an ick. My ick was that we're not supposed to wick over here. Why aren't we supposed to wick over there? Because that weekend was the weekend that the US and Iran conflict started. And as I said, if we have uncertainty, well, we're supposed to go up. Now remember the nuance that I told you, when there's a crash, everything crashes. Well, in this case, that was one of those moments and the USD started to go up. Now, why did the USD start to go up? And how does that even make sense in this situation? Well, the US started bombarding Iran. Iran is in control of one of the biggest oil straits called the Strait of Hormuz. Now, why is the Strait of Hormuz important? Because the Strait of Hormuz is responsible for the passage of 20% of the global oil, which means that 20% of the world's oil goes in and out of that same strait. And what did the whole market doubt? That Iran was going to shut off the Strait of Hormuz. And if we remember that I was talking about supply and demand, well, what happens if 20% of global oil is stuck and can't move? Well, that means that we have the same demand for less supply, which automatically means that oil prices go up. Now, how does oil prices going up affect the market? And what does that have to do with the ick that I found? Oil is one of the biggest inflation indicators. And if oil prices go up, that means that inflation goes up. And if inflation goes up, do you guys remember what I told you? There is a risk of the central bank hiking interest rates. And if interest rates go up, that means that the USD goes up as well. Now, if you guys remember, I told you guys here we're trading gold versus USD, which means that if USD goes up, that automatically means that gold goes down. And one other reason why oil going up was such a huge push for the American dollar, well, because the number one currency that oil is bought with is the USD. Which were two very big reasons for the USD to start gaining in value once again. At this point, I had trailed my stop loss right over here, and I told myself that if we start moving back down, I am exiting from this position. And if we let the next candle hit, we'll see that we were stopped out. And me having a fundamental understanding prevented me from losing all of the gains that I did, because afterwards we see that gold started to have a major crash, and it is the same crash that we are still in today. Here you guys can see that this was where I exited the trade, and today's price action has reached right over here. Well guys, that was a whole breakdown of my institutional process of taking trades. I hope this video helped you a lot and helped you understand the importance of fundamental analysis. If so, leave a like, subscribe, and I hope to see you guys in the next one.